Hey everyone, Dave here with your latest GatePass Market Monday. So fall weather's back here in the Midwest, in the Northeast, and it's safe to say that volatility is back on the menu as well. So we just had one of the longest stretches in the post-COVID era, 33 days of trading to be exact, where we didn't have a 1% move to the upside or downside for the S&P 500. All of a sudden, October comes around and we get a little October spookiness. But at the end of the day, investors shouldn't be too concerned about this because October is actually the most historically volatile month. And by volatility, we mean just moves north of 1% or south of 1% for the S&P 500, not the worst performing month. So at the end of the day, October's always been a choppy month. And then you throw on top of it, we have a government shutdown. We're obviously in earnings season right now. Then we talked about last week, but a potential another 100% additional tariff on Chinese goods. And now there's some concerns around credit in the credit market, right? And we had a few client questions around the credit concerns, and it's probably good just to spend 1-2 minutes talking about it. But at the end of the day, what's going on right now is there's been some private credit lending going out there to two companies in particular, right? So Tricolor and First Brands have both filed for bankruptcy and has kind of put a light right now on the credit market with some concerns. And at the end of the day, it's worth just taking a step back because this is way different than what we saw in 2023 with the Silicon Valley Bank debacle, right? That was essentially duration risk that was going on. Right now, what we have is credit risk. And at the end of the day, what credit risk is, these lenders, are they going to be able to get paid back for the loans that they've made, right? So that's all we care about. And right now, it seems like this is going to be very episodic, or whatever word you want to use to kind of call it contained, right? It's not going to be some contagion effect where it's going to be widespread. Right now, it seems like it's going to be very specific on these two companies. They had company-specific things. This isn't something that's going to go widespread right now all the way through the market and cause ripple effects. It's definitely something to be paying very close attention to. But you have to remember, this is also happening at the same time with the 2-year right now is at cycle lows. The 10-year just broke below 4%. Last week as well, right? And so typically you start to see what happened with Silicon Valley Bank in 2023 in a rising rate environment. Right now, rates are actually heading in the opposite direction right now, which is not good for savers, but historically has benefited the equity investors, right? Typically, a lower declining interest rate environment has benefited equity investors. And right now, we haven't seen anything on the credit side besides these two specific companies that has more concern that can be something widespread. And then when you look at the equity side of things, we had a meeting last week with a client who was very happy sitting in fixed income and in money market when he was getting 5% and was kind of asking if he should move some more money back to the equity side of the spectrum, but was also concerned that he was kind of investing at the peak, right? And when I hear this, I always go back to the Sir Isaac Newton South Sea bubble analogy, right? So if you're not familiar with it, back in 1719, 1720, there was a company called the South Sea Company, and there was a huge bubble that formulated around it, right? And Sir Isaac Newton, who everyone knows is probably one of the top 5 brains to ever live. He formulated laws around motion, right? Developed scientific method, calculus, invented the telescope. So like the creme de la creme for intellectual thought, right? And so really what happened was he ended up buying the South Sea Company, doubled his money in 6 to 8 weeks, and then was like, thank you very much, sold it and head for the sidelines. But then South Sea ended up tripling from when he sold it, ended up in around June timeframe. Now we're looking at of 1720. He ended up going back in. He ended up buying it very near the peak. There's actually records from his estate docs that he ended up holding it all the way through his death and lost a significant portion of his money. And the reason why I always like to bring that up, right? I mean, he's obviously an uber rational person, but got caught up in FOMO, right? And at the end of the day, people are talking about bubbles right now. And is there a probability that we could be entering one? Absolutely. I mean, there's always a probability. Nobody knows for certain right now, right? We have a benevolent Fed. softer rates right now. We have weaker growth, but at the same time, there's these blue sky expectations around AI that seems like it's trumping everything, right? So you kind of hit this funneling effect in the market with a lot more liquidity coming in and can definitely shoot up asset prices, right? But at the end of the day, and the reason why I bring that up is what we're seeing right now, this does not kind of indicate any bubble territory. It still indicates that there's still a lot of room left for equities right now. Obviously, things can change very quickly, but we still feel like equities are very solid, especially in a declining rate environment. We have, and we'll talk about in a second, but we have inflation data coming out next week, and then the following week we have the Federal Reserve, right? So there's still a lot of catalysts right now that are probably tailwinds right now for the equity markets. And then as we look ahead to this week, as I just mentioned, we're actually going to get the CPI data even though the government is closed right now. So they're making an exception. We're going to get the CPI data, and then the following week, we're going to have the Federal Reserve meeting. And then on top of it, we're also going to get some manufacturing service data as well from a regional standpoint. So we'll be paying very close attention to that. That's all we're really getting right now with the government shut down, is these regional kind of surveys and prints. So that's what we have to go off of. But at the end of the day, we do still have a little bit of data coming out this past week that we're paying very close attention to. We'll end things there for this week. Thanks for tuning in, and hope to catch everyone next week.